I have with me someone who needs no introduction whatsoever. I've always maintained that when it comes to identifying the trend, to understand which way the wind is blowing in the short term, and to also understand the top-down approach of what investors should be focusing on, it doesn't get better than this when you have Shankar Sharma on the show. Shankar, fantastic to have you back on ET Now. Thank you for joining us. Shankar, it all started with this tug of war between bonds and equities, which led to this sharp adjustment in global financial assets. Do you think the adjustment is behind us? Do you think we have the lows in place for 2018?
No, in my view, what you saw, we can get very intellectual about it, saying that there was a issue with bonds and the relative levels of bonds versus stocks. But my view is very simplified, that look, markets had been running a lot, there had been no meaningful correction, and it had to happen at some point. When it happens, usually you will, out of a million reasons, you can always point to one reason, trade war or sort of bond yields, volatility was too low, it went up. All those are only justifications. In my view, it was due. It was frankly long overdue, and it happened. But my view is done and dusted. It's behind us. I don't think we need to get too fussed about it.
So, do you think we have the lows in place for
Definitely for the US market. Definitely for emerging markets. And my view is that if you look at the global equity markets, US has been doing very well, Japan has been doing very well. On a relative basis, emerging markets have been flatlining versus global equities. That trend is going to change, and that's going to change for the better. That I think emerging markets are going to hit a purple patch, largely on the back of very strong commodity prices. So if you go back 10 years, or let's say 8 years from, let's say 2010, the emerging market bear market, relative bear market started, and it's still working its way down. Now I think that's more or less played itself out, and you're going to see a big resurgence in emerging market numbers, emerging market earnings growth, because they're still very closely related to oil prices or steel prices or aluminum prices. So I think there's a big virtuous cycle ahead of us for EMs. That may or may not be, by the way, interestingly, so good for India, but leave that aside for a minute. I think EMs are going to have a very, very good time incrementally from here on. And the other thing is you're going to also see overall weakness in the dollar, which will again further be an additional boost for assets moving away incrementally, not a lot, but just a bit away from dollar-denominated assets to non-dollar assets. And EMs are obviously the place where that money can go. So overall, I'm very optimistic for 2018. I mean, without any doubt.
Okay. Now, when you say you're bullish on EMs, let's classify EMs into two categories. Emerging markets which are commodity importers and emerging markets which are commodity producers. Are you bullish on both the categories?
Okay, that's a good question, Nikuj. Let me finesse this a bit more. EMs are broadly two large categories, if you think about it. I mean, which is basically commodity producers. The other is tech. So you have the South Koreas of the world, you have Taiwans of the world. You have in some part you have China also, because that has an increasing weightage of tech now, which wasn't the case several years back. And of course you have financials, which in India dominate and China also dominate. Overall, my view is commodity-centric markets will be rocking. And by the way, that's been the view right from February 2016. I think we've had a conversation when markets were making lows, when oil was, I think, hitting 27, 28. I think I do distinctly remember having a phone conversation, of course, live on the show with you. My view was this was the bottom of the commodity market, commodity cycle. Since then, commodities have been terrific, and as a result, if you look at a market like Brazil, I mean, that's, I think, up 80% since then in dollar terms. Russia will do very well. In that entire situation, so commodities will do well, tech is doing well. India, unfortunately, has no presence in either. Okay? That is why we are seeing India underperform. So if you're seeing India, at least the nifty part of it, I mean, leave small caps out, because I consider small caps to be of a different category altogether. I don't consider them really intrinsically part of India, because there's collection of small companies doing very different kinds of things. So let's leave that aside for a minute. Just look at large caps. Large caps are struggling in India relative to world, because the two big drivers of large cap performances across the world have been, commodities and tech, and we are totally underrepresented on both. I mean, we have a bit of steel and we have virtually no tech, because I do not consider Indian IT companies as being tech companies at all, which is the reason why you're seeing India lag. Of course, there are domestic issues also. Like we have had amongst all emerging markets, India is the only one which has had tepid growth. I mean, we can say it is whatever 5% old series, because I consider the old series to be representative. The new series doesn't make sense to me unless they rebase it going back several years. I continue to use the old series for my data, and that is at 5.5% or thereabouts, more or less. That relative to growth revisions elsewhere in the world, if you see Brazilian growth, Russian growth, they have all been revised upwards, while India has seen growth revisions which are downwards. So that relative delta, that India was supposed to have been doing a lot better than it is doing, while other countries which were not supposed to have been doing so well have been doing better. That relative differential gap between expectations has driven more money towards other EMs, and quite rightly so too. I mean, I don't dispute that trade. So while yes, markets will do well, India is a little bit of a pickle on the large cap, let's say Sensex and Nifty aspect of it, because it is underrepresented in tech and in commodities.
No, before I move forward, my compliments on that call on Tata Steel and steel in particular in 2018 when we had that chat. And if I just, for the benefit of our viewers, if I want to take notes of that chat, you specifically said that commodities, the best time to buy commodities is when there's bankruptcy and when there's blood on the street. And that was the time when some of the global commodity companies were going bankrupt. But as of now, Shankar, there is enough and more evidence to believe that the excitement has just about started in the oil market. I had Chris Wood last week on my show, and he also now seems to be acknowledging the fact that the bearish arguments for oil are significantly diluted.
I think it's a bull market in oil. Forget a bear market. The bear market got over a couple of years back. Anybody who still thinks oil is in a bear market, will need to revisit those assumptions quite soon. My view is oil is going to be rocking. It's probably the best commodity trade out there, and anything linked with oil will be automatically amongst the best equity trades out there. So, my view is, you're looking at a 20, 30, 40, 50% kind of rise in oil over the next few months or years. I'm very, very certain of that happening. And that, rightly or wrongly, I mean, for India, the Indian macros benefited because of falling oil. I mean, there's nothing intrinsically that changed in India's macro except oil, and that drove down all parameters which were negative, which is basically rates and inflation and the deficits on the twin side. Those will climb up. So you are already seeing bond yields which are looking very bullish. You're looking at FD rates have gone up. Relatively speaking, you're looking at inflation creeping up. So the entire virtuous cycle that we saw because of low oil will get reversed, rightly or wrongly. I'm not making any judgment call here. I mean, we took the good, so we will have to take the bad. And as a result of that, there is no case in India for a rate cut. There is a case for a rate hike. I doubt if the RBI will be brave enough for a hike, but I don't think you're going to see anything which is going to provide a big tailwind to growth by way of interest rates. I mean, I think you have a little bit of a problem as far as macros are concerned in India, unfortunately.
Shankar, when you say that you expect India to underperform, are you making a case that this year could be a negative year for Indian equities?
No, again, when I say underperform, I'm underlining one aspect, which is that I think we are still in a big global bull market. I don't see that ending anytime soon. EMs will be in a terrific bull market, and one interesting piece of data is that our emerging market index, and I'm sure that's true for the MSCI as well, in dollar terms has still not taken out the 2007 highs. So despite everything, the fact is that still in a big bear market rally, a bull market will start when it takes out the highs of 2007. And usually when that happens, you're going to look at a 40-50% upside easy over the next whatever couple of years. So the bull market is intact globally. In that context, India will still be in a bull market, but it may not do as well as other markets. So if you have a 10-12% up year this year for global equities, India might be up 8%. I'm just picking a number here. I'm not making call that we will be up only 8%. I'm just giving an example that we will lag. At least the Sensex, the Nifty part of the market will lag. But on the other hand, small caps, you know, hey, I mean, I've been bullish on it for 3-4 years. If you look at the return differential between these two, and so the market, Nifty or Sensex have given 12 or 12.5% since 2014. Small caps have given 45% compounded. I mean, that kind of return divergence has never happened in the history of India. And I continue to believe that divergence will persist. So it's not a bear market, it's just that relatively India will probably lag EMs and will lag global equities.
Shankar, the theme which you've played in some of your recent investments, I'm referring to things which are there in the public domain. You like to bet on companies which are in their second innings. You like to bet on companies where they've got the first cycle wrong, but you think they can come back in the second cycle. So in this kind of an environment where you think macros are challenging, does it make sense to be a small cap investor?
In fact, it makes more sense today to be a small cap investor than in any other environment, because the small cap end of the market is not really exposed to the vagaries of, you know, the larger macros governing an economy. So, you know, any number of companies which are in small micro segments or even small sector segments, and they don't really get affected much, you know, by interest rates going up or down, which could, those kind of big cyclical changes affect the large caps more. And, you know, I mean, I know all the companies that, you know, we look at, we track, we speak, and they're all looking very strong FY19s, if not time beyond that, irrespective of you know, the macro, irrespective of the politics, irrespective of what happens to national elections. They look to be fairly secure in terms of the numbers. And if the numbers are going to come through, which I do believe, you know, they will for large parts of the small cap market, you know, I see no reason why, you know, those stocks should remain 30% lower than where they were 2 months back. So those are classical buying opportunities, but large caps are going to be exposed to the vagaries of the macro, and the macros are looking problematic, to say the least.
Shankar, I think it was 2007. Yes, it was 2007. We had a conversation on why you don't like Bharti and why you were bearish on Telecom. That time the problem was RCom. Right now the challenge is Reliance Jio or RJio. But given that there is serious consolidation which has already happened in the telecom industry, is it time to relook at some names here?
Look, I mean, we stopped looking at the sector in 2007 December, and that's when we published 3 pieces of research saying, and we had no idea Jio was coming, and RCom wasn't really a factor. It really wasn't much of a factor even then, let alone now. Our call was coming out of the fact that you're looking at flatlining of ARPU numbers, if not outright declines. Subscriber growth has already reached a fairly high level, and incrementally you're going to keep seeing, you know, pressures on, you know, capex, etc., etc. And globally, if you see mobile operators, they have a huge growth spurt, and so the charts do very well, stocks do very well, and then the stocks just flatline like a dead patient's, you know, ECG for like decades. And since we have followed telecoms globally, we knew that the big growth push for all these telecoms, Bharti in particular, you know, it reached a point, and now it was just going to be a flatline stock. And go back 10 years, just a flatline stock. So whether consolidation, non-consolidation, whatever it is, you know, this sector itself has seen better days, and I don't think those days are going to come back again. And you know, I'm better off spending time looking at other parts of the market than telecoms.
You are a great you know, tape reader. You look at macros. You frankly don't care about P multiples and valuations, because that's a function of liquidity and that's a function of opinion. So if you have to really, you know, talk about your screen reading, what is the ticker telling you right now about the markets?
Oh, well, I mean, like I said, US equities did a massive move on Friday, which clearly tells you, you know, it has bottomed out. And look, people start to just get too panicky each time there is a correction. But the fact is that you will not have a bear market unless certain things happen. And one is, of course, a massive bubble or excess in any part of the world, which is significant. And where do you see a bubble right now? I mean, I do not see a bubble. I mean, I'll give you an interesting piece of data. I was just looking at the Sharpe ratio. I just ran some numbers with our analyst on Sharpe ratio for the US markets. And believe it or not, over the last several months, the Sharpe ratio for the NASDAQ is actually the best of all competing indexes across the world. And you know why that is happening? Because NASDAQ has delivered strong returns with low volatility. And why the low volatility? Because the quality of the NASDAQ companies today is far, far better than the NASDAQ we are all fixated on, which was the era of 2000 when companies with just websites were worth billions. Now you have companies making $20–30 billion in profits and cash, Googles of the world or Apples of the world. Those companies, even in a bear market, given the amount of cash they generate, given the kind of moats they have on businesses, are not going to fall 40–50%. Only companies with no cash or no profit or big leverage on balance sheets fall that much. That's what causes bear markets. Bear markets are not caused because there's a profit slowdown in cash-rich companies, and at best you will have a flatlining market, but not a market that tanks 30, 40, 50%. So if the NASDAQ is looking that secure, while it can have corrections, it has had a correction, but it's not a bear market correction, bear market move by any stretch. Whereas we see a bubble. I mean, oil is still like 70% away from its highs of 150. None of the metals are close to the highs of 2006-07 era or even 2008 era. Emerging markets are still 10–15% away from their all-time highs of 2007. S&P is 15–16 times earnings. So unless there is, I mean, look, I have seen a bubble in 2007, so I called the market for what it was. I saw a bubble in 2000, so I called the market for what it was. I don't see one right now. Clearly, I mean, I've looked around hard. I don't see any bubble anywhere. And trust me, if there is one, I will find that. But I don't see it right now. It will happen at some point. It all will come to a point when we have great exuberance or great excesses. But I don't think the world is anywhere close to those situations anytime soon.
I'm so glad to hear that, because you've been very vocal historically every time when you've smelt or you've seen or you've analyzed something which is close to a bubble territory. So Shankar, let's talk about pockets of stress. And one pocket of stress in India clearly is Tata Motors. You've tracked this one in the past. This is your erstwhile favorite. Is it time to go against the crowd right now in Tata Motors?
No, I mean, what was an old flame? You've moved on, right? We all have to move on. And I think we've interacted a few times in the last few years. And I said, look, that trade was an exceptional trade that played itself out. But I'm no big fan of Tata's management per se. Under Chandra, of course, it might be different. But historically, the Tata Motors part of the business, the domestic part of the business, has been a problem. It does seem as if there is some incremental strength in that business on the back of new products. But I just think the problems in Tata Motors right now will be a drag on the stock price, and I am not going back into their stock at all. There are far, far better areas of the market.
Shankar, so if you are of the view that oil is in a bull market and commodity and industrial commodity prices have a long, long way to go, can I safely assume that for in the short term you are bullish on Tata Steel, Vedanta, anything which has got to do with commodity or anything which is part of the commodity complex? Some of those stocks still have 15, 20, 25% left?
Yeah, I think that part of the market looks very good. I mean, broadly, if you ask me on my sectoral bets, I mean, I think commodities are obviously number one, and I think infra is definitely number two. So, though that sector has hurt, and like you know it, I've been bearish on both sectors in the past. So, as I always say, that one should always keep an open mind in investing. There are no permanent, friends or enemies in the stock market. So, I think both these spaces, which traditionally we have disliked, but we started liking them over the last couple of years, and I think that the road sector or the infrastructure sector looks very, very good. The government has plans, even if part of it materializes on Bharatmala or even otherwise. I think you're looking at a very solid set of numbers for the operators, or the builders of roads in India, or infra builders overall. The only caveat here, and I must put a caveat, I normally don't like to put caveats, but here is that there is a freeze up in lending, and that's something that anybody who's in this business will tell you, that post the Nirav Modi scam, there is a problem that banks are, and state-owned banks, and typically these kind of fundings are done by state-owned banks. The private sector banks want to give credit cards. They don't want to build roads for India. So, that's what gets the market cap. So the public sector part of it has to do that. If India has to get roads built, then it's only the public sector that will have to give the money, and they are under an absolute fear psychosis, that they don't want to go out there doing any kind of lending. So because of obviously all the events that we know of. So while the government is right to do what it is doing in terms of, obviously some arrest and investigation, all that, I think at some point some mature thinking must also come into the policies, policy makers, that by just going out as if PSU banks are a den of thieves and every single loan, has a worm in it, I think you will just kill the whole spirit of risk taking in India. Promoters will not want to borrow from banks, and banks will not want to lend to promoters. How do you kickstart the capex cycle? How do you drive the wheels of the economy? I mean, how long can we just remain a consumption economy and not have manufacturing, catching up, or capital formation catching up? That has become a hugely skewed economy. In order to correct that, you need lending. But in order to create lending, you need to create an environment which is not an environment of fear that if you make a loan, it goes bad, then tomorrow, you're facing a lifelong set of criminal investigations or all kinds of things. So we need to act maturely as an economy. I mean, and the best example I give you is that of the subprime scam, in which that was a real scam, and yet there wasn't a single arrest. There were some fines, handed out. System never was put to any disrepute by the policymakers. It was dealt as a business problem. Funding was extended swiftly. Things got back. Now, if you ask somebody who's come into the market in the last 5 years, they won't even remember what the subprime scam was. I mean, it's that far back in our memory. Then, they never destroyed confidence in the financial system. Here we have destroyed confidence, or are destroying confidence in our state-owned banks. I don't think that's a smart thing to do. So the caveat I have is that if lending freezes up, then the infra part of the story is problematic.
And I can share with experience, every time I'm meeting these PSU banks, I'm getting a sense that they are very reluctant to lend right now, the sense which we've got from SBI, Union Bank, or even Bank of Baroda. So Shankar, two more questions and we'll be very quick here. Do you think the rally in IT is more like a dead cat bounce? Stocks like TCS are now trading at P multiples of 18, 19 times, and the underlying growth will not be in double digit. Do you think this is more like a dead cat bounce because world was falling, Indian IT stocks are moving higher, but fundamentally there is very little to rejoice here?
I mean, I really do not have a very clear view on it. I was negative on the sector, 2 or 3 years back, and the stocks obviously, didn't do well. Now it's been doing well, but I don't understand the dynamics well enough to make a call that now Indian IT has overcome the challenges of the cloud and AI, etc. Whether they have remade their business models to suit the demands of customers now, I do not have a clear view on that. So when I don't have a clear view, I don't open my mouth.
So what is the best way, Shankar, to participate in financials? You don't want to buy PSBs because they are beaten, because there is a cultural issue there. NBFCs will not do well because if interest rates they go higher, there would be a challenge in terms of profitability and NIMs. And then private banks currently are over-owned by everyone. Everyone has an indirect or a direct exposure to either HDFC Bank or an IndusInd Bank, or for that matter, Axis Bank. In some cases, they're all three. So what is the best way to bet on Indian financials?
I'm not a mutual fund manager where I have to necessarily own 37% of my portfolios in financials. So I don't own financials. I don't like financials. They do very well, but in investing, you don't have to necessarily buy everything that goes up. You can simply choose the areas where you're most comfortable with, and that's an area I'm not comfortable with. And like I said, it's not a permanent view. As I said, I'm very flexible, and we as a house are very flexible with our views. But banking, is a problematic sector at the best of times. I'm not saying the private sector banks are problematic, but just that the valuations are rich, and I don't, like I've always said, to make 15% in a stock market, then it's not worth my while to look at these companies. I don't think they're going to deliver you much more than that. If the Sensex Nifty returns are 12% over the last 4 years, I'm more or less sure that private sector banks on an aggregate would have given somewhere close to that, give or take a few percent points. That's not good enough return from my standpoint. So I'll give that a pass, but there are many other places you're looking at substantial growth, and we will look at those.
I'll take the liberty of asking one last question. Where, every time you come on TV and you open your mouth, you're supposed to predict, indicate, or share something big. So what is Shankar Sharma's large cap idea for 2018? I know you like metals, I know you like, infra selectively, but what is the best way to participate in financial markets in a large cap stock by Shankar Sharma style?
I think you should buy anything to do with commodities. I think there are a few interesting plays without getting into names. Fortunately, we don't have that many commodity companies in India, so it's a small list. Some of them have debt, which makes it even more interesting, because indebted company with a good business cycle usually gives you biggest bang for the buck. One of the stocks in the steel sector was 80 rupees. Now I think it's north of 200 rupees. That trade has worked out well. So there are pockets. I mean, you can read between the lines and know stocks that you can go out there and buy.
Right, Shankar, fantastic to have you back, and thank you for joining us. And it's very reassuring to get your sense that we are not in a bear market, because historically, when you've smelled that and when you've seen that, you've not shied away from making that kind of a public statement, and I think you did that in 2008 wonderfully well. So hope to see much more of you going forward, and welcome back to India.
Thank you, Nikuj. Great being here.